Welcome to Clear Money Talk. This is where we turn complex financial topics into clear, practical insights. I'm Tim Clairmont.
And I'm Tyler Andrews. Welcome to the show. Today we got a fun one for you. What should you do with your old 401ks after you change jobs?
Oh, okay.
So here's the scenario I want you to picture in your head. You worked at a company, whether for a short time or a long time. You have an old retirement account, and you have to ask yourself, what do I do with this thing after I'm no longer working there? And you might have one old account. You might have several accounts. We see it all the time where people have maybe one, maybe up to 10, I think I've seen at the largest number over time. And the question comes, do you leave it there or do you do something else with it? So Tim and I are excited to talk about the pros and the cons of both options, so that way you can be informed on any decision you need to make with your retirement accounts.
Happy to talk on this topic. Obviously, it's one that I've spoken on several times before, so happy to share the insights. If you do have all those old 401ks, like what Tyler's talking about with 10 different 401ks theoretically at previous employers, if you've jumped jobs in different times, it's almost like cleaning up your room. You might have 10 different pairs, dirty clothes items just laying on the floor. You want to go pick them up and stick them in a hamper. And that's really what we're trying to do is help you clean up your room so that you can put those together in the hamper and make sure that they're actually working for you in the most effective way possible. I'd say one of the biggest things that we see happen is it's not just that element of feeling like you have stuff all over the place. That's certainly some of the people that are struggling with their old 401ks and they need to deal with them. Which, by the way, we use the word 401k, but it could be an old 403b, an old 457 plan, an old 401a. Those are just codes that reference subtle differences in the tax treatment. But overall, it's basically the same kind of stuff. Once you're no longer employed there, you have the eligibility to consider rolling into a traditional IRA or a Roth IRA, depending on the type of 401k, 403b, or otherwise that you might have. And all of those things, get factored in. So we'll talk, I'm sure, through the pros and cons of leaving it where it is, rolling it over to an IRA account, or I suppose, and whether that IRA account is something that you use a financial advisor to help you so that you're trying to optimize the growth on that portfolio, or whether you believe you can do it yourself. And we'll go through some of those pros and cons together, I suspect, today.
Yeah, I think that's great. And I like this selfish plug on your book.
Yeah, it's educational knowledge.
It is a great guide, if you will, on what should you do with the 401k when you have an old account. And again, I like that you hit on we're going to use 401k pretty interchangeably this podcast, but it can be any type of employer-sponsored retirement plan. Usually the rules are somewhat crossover, if you will, between all of them when it comes to this stuff. So I think one of the first things, Tim, that is worthwhile to talk about is what happens with an old 401k or retirement account to begin with. Like, doesn't just implode on itself. Like, there's some things that can happen, some things that don't have to happen, and all these nuances. And I think that's an important educational baseline, if you will. Maybe we can talk about that, just so people understand, like, what does happen when I leave the employer? Do I need to be rushing to the front door to make a decision on this today, or is it something I can postpone when maybe I'm a little bit more settled in a new job, or when I have more time on a weekend, when more time allows for it, and not having to feel stressed about making that decision on day one of leaving that employer. Thoughts?
Yeah. I think a lot of thoughts on that. I've encountered so many situations where people have procrastinated even enrolling in their 401k or their retirement account through work because they don't know what happens if they leave. And they come up with this rationalization or this excuse to say, oh, I'm not going to save in that because I don't think I'll be at this job for more than a couple of years. Well, that's not a good solution. It's not a good conclusion, especially if there's a match on your account. Because many times the match is a special kind of match called a safe harbor match, which you might be vested in immediately. So if you're eligible for a retirement account and it has a safe harbor match that doesn't require vesting, that's just free money. That's there for you. You should definitely take advantage of it and max out that retirement account contribution enough to at least maximize the match dollars. That's one of the most critical things to do with a retirement account. Now, once you have that retirement account and you've terminated employment and you're trying to figure out what do I do with it, you want to give consideration to a few things. For example, if you have that balance below $5,000, the employer often has the right to kick you out of the plan. You might get some kind of a notice that says, hey, your balance is too small, you're no longer here, we're going to kick you out. And when that happens, it's really important that you move forward proactively and try to roll that into another retirement account vehicle, whether it's your current 401k or 403b through your new employer, or whether it's an IRA account or a Roth IRA account. You want to do that because otherwise, if it's a pre-tax retirement account contribution that gets distributed directly to you, you're going to be dealing with a 10% penalty tax plus ordinary income taxes on that. So you could easily lose half the balance of whatever they send you to taxes because they send the money to you. It's an easy thing to avoid. Just make sure the money rolls over to another retirement account and you're good to go. If your balance is above $5,000, a lot of times they'll let you keep it in the retirement account. And sometimes even if it's below $5,000, they'll let you keep it in their retirement account. And then you have to weigh the pros and cons. Do I want to leave it in this retirement account through my former employer where I'm no longer there? You might have some favorable low-fee choices for investing. That's a reasonable option, but you can no longer borrow against it. So if you're using the rationalization, well, I can borrow against it. You can't borrow against it if you're not employed there anymore, because the only way to borrow against a retirement account is if it's through your current employer, so that you can make the payments through your current salary to make those payments back. Really, the only reason to keep it at an old retirement account would be you really like the investment choices and you think that the costs are particularly advantageous. One last reason would be if you're retiring at 55 years old, there is a special element that allows you to access the money without the 10% penalty tax if it comes from a 401k, 403b, 457 plan, and you retire after 55 but before 59 and a half. A key difference that we'll probably focus on for IRA rollovers versus leaving it in 401ks, 403bs, and 457 plans. I am nerding out, and we've covered so much in that short period of time. I realize I need to bring it back. This is a deeper topic than we can articulate really quickly and actually have you follow along. So if you want to wind that back and listen to it again, feel free to do that. All of it's accurate, but it is a lot. So
I think we are so not heated up about it. That's the wrong word, but energized about this topic because we see so frequently mistakes happen, money get left behind, money not being utilized as best as it could for people. And when I would say 99% of Americans who are saving for retirement are doing it in these types of retirement vehicles primarily, it's an important consideration to make sure that you are maximizing every penny to your benefit at the end of the day. And that's what we want to see people do. So selfishly, that's why we're energized on this podcast. Always trying to bring the energy, but specifically with this one. And I like that you said, let's go back a second, Tim, like you mentioned, because you had a lot of great feedback there. I think what happens to a 401k when you leave a job, it doesn't disappear, is the primary purpose of why I want to say that. You usually have 4 different options. If you've ever done a 401k rollover before, usually the sponsor of the 401k, whether that's any of those large institutions that hold the 401k plan for an employer, they'll usually read and make sure that you've received a special tax notice, which goes over your options with a 401k or any other type of employer-sponsored retirement plan for that matter. But your options usually are leave it in the existing 401k plan, roll it over to an IRA, take a cash distribution, or roll it to a new employer's plan. So you can also do that. So if you team up with a new employer and they have a 401k plan, you can oftentimes move it from the old 401k to the new 401k if that makes sense for your situation, which there are fewer times where that one makes sense, but there are some unique times where that does make sense, which we'll hit on here shortly. So just wanted to talk about it. Doesn't need to feel like rocket science. There are usually a select number of things you can do with the money, and you just want to choose the option that is the best fit for you and your situation at the end of the day. And Tim, I appreciate you articulating why people might want to leave it in the 401k plan. Sometimes they've negotiated better institutional fees for the 401k plan so that they might have lower fees than you might be able to find otherwise elsewhere.
That is rare, but it does happen occasionally.
It does happen occasionally when they have the economies of scale. I mean, think about some of those large employers where they have tens of thousands of employees potentially contributing. They're able to go to those sponsors and say, hey, we're going to bring a lot of money to you guys. And because of that, can we reduce the fees to a point where it's saving all of our employees and executive leaders that are contributing to the 401k plan money at the end of the day on fees. So really, it is rare.
I totally agree with that. Really quick though, I want to, because you might be making decisions in your head right now as you're listening to this. Oh, that's me. Oh, I have that big retirement plan. Oh, I have that low cost scenario and I've left it at that promo, and then you've just checked out and said, I'm going to move on. Don't check out yet, because one of the biggest differences between, even with those older, big, low-cost, institutional funds that we're talking about, is you're still limited to that previous employer's selection of choices. If you roll your money over to your own IRA or Roth IRA account, you can go into a diversified portfolio of basically just about anything on the planet. So you have complete free reign to design your allocation however you want. And when you get to pick your own allocation, even with those potentially slightly higher fees, you may get a much, much better rate of return, or at least a more consistent portfolio build with what you're trying to accomplish. So don't just write it off and say, oh, that's me. I've got a big old retirement account with this big older employer, and I'm sure it's a really good low cost. You're probably looking, when you're listening to this show, whether you're watching us on YouTube or listening through Spotify or Apple Podcasts, if you're listening to us, you're looking for a reason to not take action. You're probably looking for a rationalization to say, I'm fine, let's leave it alone. I got other stuff I want to deal with. And it's really important that odds are if you've got old retirement accounts, you're going to want to take action. You're more than likely going to want to talk to an advisor or have a plan where you can relocate those assets into something that's more productive for you. And if you don't take action, you're likely missing out on what you could have otherwise earned.
Yeah. Yeah, and let's talk about that, actually. I think that segues us to it. The next point I want to talk about is reasons to consider consolidation and rolling over old retirement accounts. We hit on it a little bit, but I want to make sure we can hit on it a little bit more and kind of talk about, maybe in a bullet form fashion, if you will, and the reasons a lot of people consider doing that.
Okay.
Thoughts on that?
Yeah. So reasons why people would roll it over. Let's just talk those four things that you lined up previously. So cash it out was one. Keep it in the old retirement account was another. Roll it to an IRA or 401k, or sorry, let's get IRA, Roth IRA, individual retirement account is another. Then roll it to your current employer's retirement account. That was the fourth one. So let's hit cash it out first. So cash it out, if you're under the age of 55 years old, you are going to get hit with a 10% penalty tax plus ordinary income taxes on any pre-tax money. It's not likely to be your best choice. Now, you might have a really low income year, you need the cash, and it's a small amount of money, $1,000, a couple $1,000, something like that, and you just want to go ahead and cash it out, and you're going to eat the penalty, and it is what it is. That's your choice. It's your prerogative. We respect your right to make that decision, but you are throwing away that amount, that extra 10% penalty tax that you wouldn't have had to if you relocated it into one of the other three choices, either leaving it where it is, rolling it to your new employer's retirement account, or rolling it to an IRA. All three of those would have avoided that 10% penalty tax and avoided normal taxation on the pre-tax assets associated with that account. So cashing it out generally is usually not the right plan unless you're already retired or it's so de minimis or you're over 55 and there's no penalty tax from that's when you stopped working. By the way, if you stop working at 54, it doesn't mean that once you hit 55, you can access that money without the penalty tax. You have to have stopped working after 55 in order to be able to access that money as an early retirement distribution that's not subject to the 10% penalty tax. Mm-hmm. The next choice, let's go with leaving it in the old retirement account. We talked about that briefly. So from a bullet capacity, the best reason for doing that is, frankly, the most likely reason for doing that is you're lazy and you're not doing it. So which is fine. There's nothing wrong with that. We're all lazy at different times. I'm not judging, just saying that you might be ignoring it because you just don't want to deal with it. So by default, it ends up in this old account. The only reason I can see where you would want to leave it there is that potentially lower fee that was negotiated and particular investment strategies you really, really, really like. And don't just look at your rate of return. If you're looking at your rate of return in the last couple of years and you're using that as justification to leave it where it is, it's very nearsighted. You might be taking twice or three times as much risk to get a slightly higher rate of return than another investment vehicle. You might be able to significantly reduce your risk in a diversified portfolio and still get comparable performance. Or you may be underperforming. You may be getting a little bit lower rate of return, but you're like, oh, it's close enough. You might be taking 2 or 3 times as much risk, getting a little lower rate of return, and you could have significantly decreased the risk and also improved your performance by relocating into something that's a little wiser. So don't let rate of return fool you. That is not the only thing to look at when you're looking at these old retirement accounts. But then we're moving it to your current employer's retirement account. That's one way to catch all of the old stuff and kind of have it carry forward with where you're at. The only benefit to that I see as an advisor is you could borrow against that new lump sum that's now larger. You can borrow up to 50% of the value of your 401k or 403b account through most active employers if you're still working there, not to exceed a maximum of $50,000. So if you have $100,000 or more, you can borrow $50K. If you have less than $100,000, you can borrow half of whatever the balance is in your account. And you have to pay it back through your payroll, so it's going to come out in that capacity. The interest that's being charged is actually being paid to you. You're paying interest and it's going to you. So that's actually a pretty cool benefit. But the problem that happens is if you terminate your job and you still have a loan on that 401k, that loan can be treated as taxable and penalty taxable unless you come up with the money to pay it all off as soon as you terminated your job. Generally speaking, if you didn't terminate your job voluntarily, it might be a tight financial time for you. So coming up with that money to pay it all off is not necessarily easy to do. Rolling it to the IRA account or the Roth IRA account, especially if you work with a financial advisor, is, in my opinion, likely to give you the most flexibility of building that diversified portfolio, more customized towards what you want. You can control your cost structure by making choosing the options that you choose. And it actually opens the door to a bunch of other options that don't exist in the 401k and 403b world. For example, stuff that we've talked about in the past, like variable annuities, fixed indexed annuities, registered indexed linked annuities. That whole world of annuities is available in the IRA, Roth IRA world, and it's largely not available in your 401k and 403b world. And not to say that you should or shouldn't use annuities, but it is another option worth giving some consideration.
One thing I think is worth mentioning too is the benefit of either leaving it in the 401k plan or rolling it to a new 401k plan is if you are a high income earner, whether you're filing single or you're filing married, filing jointly, if you are being phased out of making Roth IRA contributions, and that's something that you are inclined to continue to do outside of your 401k retirement plan, you're maxing out a Roth IRA as an example, you are likely doing that as a backdoor Roth IRA contribution, which means you have to take an extra step to get the money into the Roth IRA and not have any adverse tax outcomes from that. And there's this silly rule that the IRS imposes. It's called the pro rata rule, and it basically says we're going to look at all the money you have in pre-tax IRAs and use that in the calculation to say how much of your backdoor Roth IRA contribution is going to be taxable. You don't want any of it to be taxable. So usually if you have any money in traditional IRAs, it negates the benefits of doing the backdoor Roth IRA strategy to begin with. However, leaving it in an employer-sponsored retirement plan like a 401k excludes it from that calculation, which means you can continue to do those contributions. So if you are somebody that is doing that and it's part of your broader financial planning strategy, give that consideration before just choosing to roll it over to an IRA. A lot of the times it can still make sense to roll it over to an IRA, even if you lose the ability to do that, but it's very case by case and situational, and just don't step in that pothole if it's important to you to avoid that pothole.
Yeah, that's very smart and well said. It's a niche or niche that makes sense if you are doing backdoor Roth IRA contributions and conversions. You already probably know what that is if you're doing it. Sure. Pay attention to rolling your money over from an old retirement account into an IRA. It could mess that up for you. And it's just good to be aware of. If you are converting it all into Roth money anyway, that's fine. It's another way to get rid of that risk if it's all Roth accounts. But then you have to pay taxes on it, of course, when you do the conversion. So it's worth paying attention to that situation if that's what you're dealing with. So excellent point.
Yeah, thank you. So thank you, Tim, for giving all those phenomenal reasons to consider consolidation and the differences between the four options that you usually have with your retirement assets. I'd love to go through with you, Tim, really quickly and go over the reasons to consider the consolidation to an IRA.
Sure.
And we can just hit on each of those briefly. The first is simplicity and visibility.
Yeah.
What are your thoughts on that?
Yeah, I mean, a lot of times people have stuff, like I said, the dirty laundry all over the room, just getting it together so you can actually see what's going on and easier. It makes it easier on your own mental taxing. I mean, the amount of attention that we have and energy that we have is limited. And if you have it all in one place, it's easier for you to keep an eye on it. When it's all over the place, it's a lot harder to keep an eye on it. Yeah. As simplistic as that may seem, it is, it works better in your mental aspect. One common misconception about math, however, a lot of people say, oh, if I add them together, I'm going to make more money. Technically, math doesn't work that way. If you get the same rate of return on 4 or 5 different accounts and you add up the total earnings on all of those different accounts and you compare that to the same rate of return if it was all in one account, it will look like you're making more money because there's a bigger dollar amount being added to that one account. But the total dollar amount of all the earnings in all the other little accounts should be equal to the dollar earnings in the one big account. It's just mentally easier to pay attention to. Again, that assumes a pure apples to apples identical rate of return in all the little accounts versus one big account. But if you're rationalizing, oh, I'll put them all together because I make more money doing that, technically that's probably not mathematically true, unless you're investing it better in the one account.
Thank you for mentioning that. That comes up so frequently.
Yeah.
And a lot of people are so hard and fast in their belief set with that, it's hard to educate them that isn't always the case, and it doesn't work that way.
For the benefit of those that are still arguing with me right now on the other side of the screen. So if you're like, no, it doesn't work that way. I make more money if I do. Let me go through this math example with you really quick.
Please, actually, this is worth the time.
Let's say that you have 3 old retirement accounts and each one has $100,000 in it. So you've got $300,000 total. And let's say hypothetically, each one earns a 5% rate of return. Now, I hope you earn a lot more than that. Of course, there's no guarantees on what kind of rate of return you're going to earn, but I'm just going to use 5 to keep our math easy. So if you have 3 accounts with $100,000 in each one and you earn a 5% rate of return on each of the 3 accounts, then at the end of 1 year, you would have earned $5,000 in each of the 3 accounts. Thus, each balance would be about $105,000. If you add up those 3 accounts together, 105, 105, 105, you get $315,000. If prior to earning the 5%, you merged all of these accounts together into one account with $300,000 in it, and you earned a 5% rate of return on that one account with $300,000, you would have earned $15,000. So the 300 would be worth $315,000. Now, you might see little accounts earning $5,000 and think, that's not that much money, and then see a big account earning $15,000 and say, that's a lot better. That's true, but it's still just 2 different ways of looking at the exact same thing. At the end of the day, overall, you didn't necessarily make more money there from a math standpoint.
Yep. That's as good of an example as we could have used for that. So thank you. Thank you, Tim. Another reason to consider consolidation, reduced chance of forgotten accounts. So going back to that example I mentioned earlier where we have seen somebody have like 10 old retirement accounts, and some of them, they don't even remember where they exist any longer. So then it became a fun game of calling a bunch of different companies, trying to dig up old files out of the cabinet and trying to find those lost monies. That's not fun, and that's a headache, and you are going to have serious FOMO, fear of missing out, if you can't find all of those retirement accounts. Even if it only has a couple $100 in it, that's still going to feel bad. No one wants to feel like they're lighting money on fire at the end of the day.
What if you passed away, or if you're incapacitated and now your beneficiary has to figure out where all that old stuff is? Like, that's not great. If they miss any of those accounts, that money is gone. It ultimately gets turned over to the state, and they have to go back and try to figure out how to claim it from the state. You know, money, millions of dollars, billions of dollars go unclaimed by all of the states all the time because people forgot. They forgot where it was, and then whoever was supposed to receive it didn't know about it, and thus the state keeps the money. So if you really want to keep your money, then it's best to clean up your room and put your dirty laundry in the hamper.
Well said, and that's a nice segue actually to the next one of considered consolidation is cleaner tax and beneficiary planning and coordination.
Fair.
So beneficiaries can often be not adequately structured between all of your different stuff at the end of the day, and having multiple old retirement accounts elsewhere can oftentimes be forgotten, and then maybe it has old beneficiary designations. Let's say you get married or go through divorce or have children, or something happens within your lineage of who you'd want to leave money to prudently, and you don't go and remember to update those old retirement accounts, you might be leaving money to somebody that you otherwise didn't want to. Similar thing with taxes. One of the best examples of taxes on old retirement accounts is RMDs, required minimum distributions, that you have to start taking money out of your retirement accounts at age 73, as of today when we're filming this podcast. Those don't aggregate with your other retirement accounts, like your traditional IRAs, as an example. So if you are 73 and you have to take an RMD, you're going to have a separate calculation for your 401ks than you will have with your IRAs. And that becomes increasingly more difficult as you are more hands-off, assuming in retirement, and where somebody else might be helping you with that stuff, like we do with a lot of our clients. We can't calculate the 401ks because we don't have visibility on them. So aggregating those with your IRAs by consolidation, if you will, can sometimes just be cleaning up your room.
Yeah,
to mention.
It's smart. There are a lot of things from a tax planning standpoint. In fact, another example comes to mind, which I appreciate everything you just said, Tyler. It's right on. It's on point. Many of our clients have several millions of dollars, and that's not uncommon. When you have a larger estate, if you have millions of dollars in terms of net worth, you may have some inclinations of leaving assets to charities. And if you want to leave money to a charity rather than individuals, or in addition to individuals, for example, oftentimes you don't want the same beneficiaries across the board on all your accounts. it might seem easy to you to just structure everything identically across your accounts and say, well, I'm always going to leave my money to this primary person, typically a spouse if you have one, and then this contingent person, these kids, and so on. And that's fine as far as the planning of that is concerned. However, you might say, I want to leave this primary to my spouse, and then the contingents, I want to leave 30% to charity and 70% to my kids. That's not uncommon either. As soon as charity gets thrown into the mix, it's better for you to carve out your overall planning to look at something like take the pre-tax retirement money, leave a portion of that to cover all your charitable needs, because the charity won't have to pay ordinary income taxes on receiving that money, nor have to worry about any of the penalty taxes or any of that. They can just take a lump sum and the money goes to the charity. Whereas living beneficiaries, your children, your grandchildren, your spouse for that matter, they still have to deal with taxation on all of that money. And you don't want to necessarily leave Roth money to charities. That's better to leave to individuals. And you want to leave pre-tax money to the charities, which means your beneficiaries shouldn't all look the same on all your accounts. They should look different. And if you're not paying attention to that and structuring it correctly, you're missing out.
Yeah. I love that we just keep coming up with these new ideas
Yeah,
as we talk
FOMO.
through it. Yeah.
I mean, it's stuff we deal with all the time, but there's a lot of stuff to talk about.
There's
here,
a lot of
so,
stuff to talk about, and I want to start to bring this to
we got to bring it to a close. Let's do just the answer.
Just the common mistakes to avoid, which we already talked about these. I'm just going to go through these really quickly.
Okay.
Cashing out unintentionally. If you mean to do it, okay, just know what you're doing. If you don't mean to do it, don't do that. Don't do that. Missing rollover deadlines. If you have a deadline, like you have a small retirement account, they're going to force you out because of it's a de minimis balance. Try to make the decision before they make the decision for you. Triggering unnecessary taxes. Forgetting to update beneficiaries. We just talked about a minute ago. And then consolidating without understanding the trade-offs. So if you are going to consider consolidating, whether it's to an IRA or to a new employer-sponsored retirement plan, understand the trade-offs. That's the most important thing, is understanding. And this podcast is not about consolidation, is just about having fewer accounts, or so my advisor can manage the assets. It's really about coordination, clarity, and intention with everything. So if you have coordination, you have clarity, and you have intention with the choices that you're making, that's the most important thing at the end of the day.
Yeah, I mean, and as you think of our 4 values, education, choice, transparency, empathy, we're trying to teach you so you can make an informed choice about what to do with your money. And we're trying to be as transparent as possible about all the pros and cons, costs and benefits, what we can control, what we can't control. And ultimately, when our clients turn to us and say, I get it, Tim, I understand this, but I'm about to make this choice, I'm thinking this choice, which one should I pick? We actually give them an empathetic recommendation, what we think is right for them at a human level, because not everybody's the same. And your plan shouldn't look identical to your sibling or to your cousin or to your neighbor. Your plan should look uniquely right for you. And if it doesn't reflect that, then some adjustments probably need to be made.
That's right. Okay, just the answer.
Just the answer.
We're going to have to trim this one down a little bit, because we talked about a lot of stuff. If you're listening right now to me, listen to the full podcast. And I guess if you're listening to me right now, that means you listen to the full podcast. So thank you for that. Just the answer. Today, Tim and I talked about what should you do with old 401ks after you change jobs. The first thing that we talked about was, what options do you have with an old 401k plan? The options are leave it where it is. Sometimes you can just leave it in that old 401k plan. You can move it to a new 401k plan with a new employer. You can roll it over to an IRA or a Roth IRA, and you can also take a cash distribution from the plan. So we talked about the 4 things that exist as far as what you can do with your money and what you can't do with your money. Then we talked about reasons somebody might want to leave the 401k at the old employer plan. Do you want to hit on those really quick, Tim?
Yeah, I think just in the interest of brevity, if you want to really unpack this, there's a lot of really good meat in the long show. So I would encourage you to listen to the long version. But fundamentally, if you take the cash distribution, you're going to be dealing with a penalty tax of 10% plus ordinary income taxes if it's pre-tax money and you're under the age of 55 years old. If you retire after 55, you can avoid the penalty tax, but you're still going to be paying the pre-tax income tax consequences. Rolling it to a 401k through your new employer is a way to sort of pick up your laundry and clean it up, put it all in the hamper so it's in one place. Not a bad option. It gives you accessibility as far as borrowing against your current active employer's retirement account. And it just creates that consolidation part to just be able to see it all in one place. It's simpler. It's less taxing on your mind. However, you are going to be limited in your investment selections to whatever your new 401k has available to you. If you roll it over into a retirement account like an IRA or Roth IRA, if it's a Roth 401k or 403b plan, you have the unlimited investment choices available in the world, and you can build and design your own portfolio. Whether you do it yourself as a DIY or whether you work with a financial advisor, you'll have the most flexibility in an IRA, Roth IRA. But realize the IRA, Roth IRA options are going to restrict you to not touching until 59.5, where you're going to have that 10% penalty tax, Whereas with the 401k, 403b, if you retire after 55, you can avoid that 10% penalty tax directly with the 401k or 403b options. A lot of additional information was covered in terms of this just the answer. And if you leave it in the old retirement account, of course, I think that's the easy button, but it's not really the lazy button, let's be honest. Probably not the most optimal choice unless it's very intentional and you've already analyzed all your other options.
Yep, well said, Tim. Some of the common mistakes to avoid that we talked about was avoiding cashing out unintentionally if it's not something that you wanted to do, triggering any unnecessary taxes, trying to avoid that if possible, forgetting to update beneficiaries. If it's an old retirement account, you kind of set it and forgot about it, and your situation changes, make sure that you remember to go back and update beneficiaries. And then just consolidating without understanding the trade-offs. If you do decide to do that, just make sure you understand what you're trading, pros and cons and all that stuff. There's always more to learn.
Yep.
Let's have some trivia, Tim.
Sounds good.
What do you think? You are going to love this one.
All right, great.
Tim, I'd like you to tell me, what percentage of airline luggage that's lost is eventually recovered?
Ooh, interesting.
This one hits home for you, doesn't it?
It does. I mean, I travel a lot, and I've had my luggage lost, I think 3 or 4 times. So every time I did get it back eventually. Now, if my personal experience were consistent with everything else, then it would be like 100%, which I know is not the case because there is some luggage that is lost permanently and never recovered. My suspicion, though, is that I would bet that
I'm looking for a threshold.
85.
Like over this.
I would say 80. I bet 85% is recovered. I would think that and eventually transitioned on, and maybe you only have a 15% chance of not getting it. That even feels a little bit low. I feel like it's probably above 90%. So I'm going to say above 85, and I hope I'm right. If it's lower, that's just going to be really painful and scary.
That's actually a really good guess. It's actually over 95%.
Oh, nice.
Which is great. So most things aren't truly lost. They're just sitting somewhere you're not paying attention to, kind of like those old retirement accounts you got.
There you go. So it's not true. That's a nice parallel.
Yeah,
well done.
That?
Yeah, I saw that. Yeah, I saw what you did there. That was good. Yeah, well done.
Thank you for joining us today on Clear Money Talk. We appreciate the time you spend with us.
We hope today's conversation brought more clarity for you, and you have a lot more clarity going forward in terms of your future planning.
Yeah, and if you found any value in the episode, please share with a loved one, family member, a neighbor, your coworker, that person you don't like. Share with them still, too, and consider subscribing so you don't miss future episodes.
That's right. Thank you for joining us on Clear Money Talk. Until next time.
Tim Clairmont and Tyler Andrews are investment advisor representatives offering securities through Cetera Wealth Services, LLC, member FINRA SIPC. Advisory services offered through Cetera Investment Advisors, LLC, a registered investment advisor. Cetera is under separate ownership from any other named entity. The views depicted in this material are for informational purposes only and are not necessarily those of Cetera Wealth Services, LLC. They should not be considered specific advice or recommendations for any individual. For a comprehensive review of your personal situation, always consult with a tax or legal advisor. Cetera Wealth Services exclusively provides investment products and services through its representatives. Although Cetera does not provide tax or legal advice or supervise tax, accounting, or legal services, Cetera representatives may offer these services through their independent outside business. This information is not intended as tax or legal advice. All investing involves risk, including the possible loss of principal. There is no assurance that any investment strategy will be successful. Examples referenced are hypothetical only and do not represent the actual performance of any particular investments. Distributions from traditional IRAs and employer-sponsored retirement plans are taxed as ordinary income and, if taken prior to reaching age 59.5, may be subject to an additional 10% IRS tax penalty. A diversified portfolio does not assure a profit or protect against loss in a declining market. Although it is possible to have guaranteed income for life with a fixed annuity, there is no assurance that this income will keep up with inflation. There is a surrender charge imposed generally during the first 5 to 7 years or during the rate guarantee period. There is a surrender charge imposed generally during the first 5 to 7 years that you own the contract. Withdrawals prior to age 59.5 may result in a 10% IRS tax penalty in addition to any ordinary income tax. The guarantee of the annuity is backed by the financial strength of the underlying insurance company. Investment sub-account values will fluctuate with changes in market conditions. An investment in a variable annuity involves investment risk, including possible loss of principal. Variable annuities are designed for long-term investing. The contract, when redeemed, may be worth more or less than the total amount invested. Variable annuities are subject to insurance-related charges, including mortality and expense charges, administrative fees, and the expenses associated with the underlying sub-accounts. Investors should consider the investment objectives, risks, charges, and expenses of the variable annuity carefully before investing. warning. The prospectus contains this and other information about the variable annuity. Contact Clear Financial Partners at info@clearfp.com or 503-579-1000 to obtain a prospectus, which should be read carefully before investing or sending money. Before deciding whether to retain assets in a 401k or roll over to an IRA, an investor should consider various factors including, but not limited to, investment options, fees and expenses, services, withdrawal penalties, protection from creditors and legal judgments, required minimum distributions, and possession of employer stock. Please view the Investor Alerts section of the FINRA website for additional information. If you're considering using the backdoor Roth strategy, be sure to understand the potential tax implications and consider whether it makes sense in the context of your other financial goals. This is for informational purposes only. Clear Financial Partners is located at 15573 Bangi Road, Suite 100, Lake Oswego, Oregon 97035. For more information, please call us at 503-579-1000.